Good morning, everybody, and welcome back to Money in the Law on my FM 101.3. Everybody got in a little early today.
Yes.
So we're kind of ready. We're like leaning forward in the foxhole.
I mean, it's the same time as usual for you guys, but we were here ready to roll. Taping-wise, we were here early.
Right. So as you know, this is Money in the Law. We are live. Well, not live. We're recorded
Kinda
sort of
live.
live-ish. You know, it's just on my FM 101.3, the hometown news, the hometown local station that owns Milford, Massachusetts.
They do.
Yep.
Yep.
And we're
we handled the purchase and sale for that.
There you go.
Yep.
And we're also on Holliston Cable Access TV, or the Holliston Hub, which I'm going to start saying it now because it's coming. It's coming. It's coming.
Soft launch, they call that. Soft launch.
This is probably the softest launch, depending on how many thousands of people are listening.
That's all right. It's good.
And of course, Tom Harmon is in the room with us once again. Tom is the Holliston Cable Access. He is our guy. He is.
Yeah. Yep. He's the man.
Yep. No relation to anyone else.
By the way, and if you notice, he's proudly sporting that Boston Bruins hat today. I mean, that looks pretty polished up.
Today is
as do they.
As we record, today is Wednesday, and the Boston Bruins have just last night have broken the total points record.
Yes, they did.
For a single season in the NHL, putting them as right up there as one of the greatest NHL and greatest seasons.
Sure,
is it one of the greatest teams? That kind of remains to be seen.
Yeah, more to come. We'll find out.
But yeah, and if they continue and go on and win the Stanley Cup, I heard this argument today. You could make the argument that they could be one of the greatest sports teams in Boston history.
Whoa,
we're talking and there's some pretty good teams, right?
Oh, you got some good company. You got some good company.
Yeah, the Celtics. So that's good. So. I'm your host, John Drohan, and I'm here with my
co-host.
I'm one of the hosts. I'm maybe the secondary host, and the other host, who you've heard doing a little bit of talking so far. That's Jay Marsden. Jay, how are you doing today?
Doing well, my friend. Doing well. How are you?
Good. Better because last week we didn't have a show. Last week,
no,
you had a business trip that you had to take care of, right?
I was actually out with affectionately known as the Bible Study Boys from Holliston, and we were down.
Shamelessly Bible study. Yep. Shameless Bible study.
Yep. And we were down in golf country praying on a regular basis. You know, praying that shot goes in, praying that I make this shot, praying all that stuff. So very prayerful week for us.
It's funny. So like right when you say when you hear Bible study, you think, oh, this is like a really serious thing. Guys are like very intense, Bible study.
It's serious and intense.
And then it reminds me of when I was a kid. We went to I went to Catholic school as you did.
Yes.
We went to a retreat at this monastery with a bunch of, and there was maybe like 20 monks. And I'd never seen or met a monk before.
Yeah.
And I'm thinking these guys are all serious. Maybe they don't talk. They all got that weird haircut. Nobody ripped it up more than these monks.
Oh yeah.
I mean, these guys were drinking beers in front of us.
Well, that's because they make them. We're the Spencer Abbey guys. I mean, come on, for crying out loud.
That's right. And all of them had guitars, and all were they're like, do you know Freebird? You guys know the words to Freebird? And I'm like, wait a minute, isn't this supposed to be like a religious retreat?
Oh yeah.
Yeah. They're like,
they get down. They get down.
They're like, it is.
They get down. So these are all guys that I had the good fortune to meet as part of the St. Mary's mission trip.
That's right.
We did a bunch of trips down the south after post-Katrina.
Doing the Lord's work down there.
That's right. So we did a bunch of those. And then as the kids all kind of moved through the system, we all were fortunate enough to
We're gonna stick around.
That's right. We kind of realized we enjoyed each other's company a little too much, and so here we are.
And you all have any, scratch golfers as well.
Oh, so absolutely,
so you're throwing a little golf, right?
I mean, okay, while you guys are all watching the Masters, I mean, you could just watch us for nothing. Yep, same thing.
You're watching the Masters. We actually were the Masters.
That's right. That's right.
The other Masters.
A lot of us are sliding into the Masters category, but that's fine too. Yeah, that's fine too.
That's a great
So it's all good.
Man.
Yep, it's all good. It's all good.
All right, so it's good to be back. One of the things I was talking about. So we have some mutual friends. There's one guy, I won't mention his Ken Sawyer's name.
Right, don't say that.
On the radio. I'm not going to say Ken Sawyer's name on the radio, just to protect the innocent. But I had this funny thing happen. So yesterday I got on the phone. Remember your buddy Dave Birmingham?
Yes,
Dave,
the great Dave Birmingham. Yeah.
So I called Dave. I haven't talked to him in a while, and he says, "Oh, I was just having coffee with Ken Sawyer's this morning." I'm like,
"Nice.
What?
Yeah.
Right?" And I get this
almost feel left out, didn't you?
Do I ever?
Yeah.
Right.
Yeah.
So then I started thinking about it, right? And I was about to send Kenny this text. I'm like, wait a minute. So you're coffee with Birmingham, and then as I walk in, you're like, oh, what? Last night I walked 9. Who were you playing with?
Yeah,
Ken
Sawyer's.
Ken Sawyer's, right? And I'm like, so I feel like kind of almost like a jilted high school, I don't know, whatever you want to call it.
Sawyer's, for the record, who can hit the ball a country mile.
Yeah, whatever.
Yep.
Yeah, whatever. Every now and again he gets lucky.
Yep. Well,
yeah. So I'm scheduled to hang out with Sawyer's on Friday.
There you
so
go.
just
Nice.
he's on my list.
There you go. All right. Well, behave yourselves.
All right.
Enjoy.
So what do you? Oh, I know what I'm interested.
You came in here guns blazing. You had something you wanted to talk about.
So for some reason today, I was thinking about
Drum roll.
mistakes. Like what are
yeah.
what are mistakes? What are there's some like no-brainer mistakes that people make financially, they make legally, and they're these things that like people that they'll when we as like professionals kind of who are in the business or in whatever our business is, we see this, we're like, ugh, like why did you do that, right? And you'll have a client that'll say, yeah, well, so what I decided to do, I decided to take some money out of my IRA and blah 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 blah.
Bought a car.
Yeah, right. Or I refinanced my house, took cash out, and
Went to
and
a
spent
casino.
money and did something right. So I'm going to talk about some of kind of the. And maybe not to
Not
that
mistakes,
extreme.
not mistakes, but advice to a younger you.
Yeah, so you'd say, look, listen, this is, if you want to do this, like if you want to take a loan off of your 401k, there's got to be specific reasons. If you want to take home equity line of credit out on your house, here are the reasons why you should do it, and here are the reasons why you shouldn't.
Yeah.
If you want to say, not save money in your retirement account versus saving it somewhere else, you say make sure you're doing it for the right reasons. And if those aren't the right reasons, if you're doing it for a reason that we're like, then there may be a better way to do that.
Sure.
So I want to talk about
that. Works.
I'm going to talk about some mistakes. All right. So what else is going on in town?
In town, not much.
There's nothing happening in town.
Well, you're
right?
talking to the wrong guy. I mean, nobody. I'm not that looped in. I'm not that dialed in anymore. So
no, but
nobody,
you're there. You have your fingers on the pulse. You have the heartbeat.
Yeah. My phone doesn't ring too much about town stuff these days.
There's going to be on May 13th. There's going to be a downtown marketplace over at our place. Yeah, a little outside. Yeah, there's going to be some food trucks. There won't be any. The beer guys won't be there for this one. We'll have
it at our place.
It's a trial run. Yeah. Swing up to 847.
Yep.
Yeah, he'll be there.
That's right. That's right.
All right.
So we'll take a quick break, and then everybody think about your mistakes. Don't say them out loud because you can get yourself in trouble. And then we'll come
These
back.
are there's all kinds of mistakes. These are more like financial or legal mistakes.
Yeah, I got you. All right, we'll be back in 2 minutes. We'll talk some mistakes. We'll talk about not mistakes, but things you would have done a little bit differently, things you would have approached a little differently, and then we'll do our confession on this end. And, we'll spit it all out and see how it goes for you. All right. We'll be right back. Money in the Law, My FM 101.3. Jay Marsden, John Drohan, Main Effort Financial, and we will be right back.
And we're back. Welcome back to Money in the Law, My FM 101.3.
Well played, well played.
I'm John Drohan from Main Effort Financial, Jay Marsden from the Marsden Law Group. What happened just there was something that doesn't happen very often.
No, I'm usually not paying
Jay takes
attention.
us out. We have kind of a system. We have a system, and it's not like we've rehearsed it. It's just kind of it flows naturally.
It's the natural progression
So
of
we did it,
life.
and so it does feel weird. So Jay took us out. I brought us back in.
It's awkward.
I think I hacked it up. Jay coming out probably wasn't as good. Yeah.
Smooth.
So here we are. So we're talking about some errors, like maybe some errors
little
that people
do-overs
make.
if you could. Yeah, that's right. That's right.
So the first I'd like to let's address some of like maybe a financial kind of retirement error or retirement account error that we see relatively often and again it's based on what people kind of their understanding or limited understanding of things. So it's the 401k loan. Okay.
Oh yeah.
So the 401k loan is most 401k plans will allow a participant to be able to take a loan off of their 401k, and in many ways, in many situations, it might be the right idea. It might be a good idea to do it.
Well, and the reason that people talk themselves into it easily is they give it the old, I'm paying myself back the interest.
Well, that's the benefit of it, right?
That's the sales pitch, right?
That's kind of the cool thing about it is that and what Jay's talking about is that you have you take money out of your 401k. And it's a loan. It's a bona
Joe
fide
Blow
loan.
Yep.
And there's whatever the going interest rate is, that's the rate that you have to pay. However, so when you repay back your loan, it comes. Remember, the way you contribute to a 401k is through a salary reduction, right?
Yep.
So part of the money that's coming out of your salary is going to go into your 401k to repay the loan as well as pay the interest. But all that does is it all goes back into your 401k. So your
Yeah.
401k, however it's invested, all that money goes back in. So it's like you're taking a loan from yourself, you're paying interest, but all that interest goes back to yourself. So in that respect, not bad, right?
Hey,
Not-
what,
I mean,
what,
not-
what could be worse than paying yourself back?
Yeah, and as opposed to taking a loan from any other source
Right,
where you
bank or
that you
something
don't
like that,
you don't
yeah.
get to keep that interest. That
Yep.
interest goes to whomever it's who's supplied the loan. So, but the thing about 401k loans is kind of the other side of that coin. Is people will take a 401k loan, and you can, for most plans, it'll allow you to do it for anything you want. There's not a restriction. Say, oh, you can only take it in case of emergency.
Right,
You
it's
can
not
only take it in
education,
case.
it's not real estate.
Exactly.
Right,
Exactly.
right,
So
right.
and so there's some of the rules that go along with it. People either they don't really kind of understand it, or they kind of blow it off. And what happens is what you're doing is you're affecting your retirement. And this is the point I'm trying to make, is that your 401k, for most people, that's your primary retirement savings
That
source.
is ground zero for retirement.
Yeah,
Yep.
for many people. And so what happens is anytime you affect that, because remember, you've worked so hard to kind of get to the point to be able to put money in your 401k,
Right,
right?
right.
Or any type of retirement account. You're like, and we always say that, in the finance world, everybody preaches, save for retirement, save as much as you can, save.
Well, and it takes a long time to save the amount of money to then put yourself in a position to be able to borrow back from it. Takes a lot of effort
Exactly.
to
It
save
takes
that much money.
Right? Think about it, right? Because there's a limit as how much you can put in per
Yep.
year
Yep.
into your 401k or into any type of an IRA. So you get to this point where you're like, I've saved all this money, and then I'm going to take this money out. I'm
Yep.
going to take this money, and what I'm not going to use it for, I'm not going to use it for retirement.
Right.
Like this is, because that's the thing, is we talk about how investments need to have a purpose. The primary purpose of your retirement investment is to augment your income in retirement. It is so you can stop working someday, or stop working whatever your current job, and take that money out and use that to buy gas, to buy beer, to pay your mortgage, to pay your rent, to buy a car, whatever you need to live, money
Yep.
to live.
Yeah.
All the way up until you get to be age 110. So it's a big deal when you take money out of your 401k. And so if you're going to do it, you have to do it for the right reasons, and you have to understand like the ramifications of it, right? Because again, the other part of it as well is like, so if let's say I'm putting $1,000 a month into my 401k.
Yep.
I take a loan off, and then after I have a loan, I have to repay that loan. So what happens is, if budgetarily I can only afford to put $1,000 a month into my 401k,
Right.
then guess what? That $1,000, not all of it is going towards saving towards investment, right? That money is going to repay the loan. So it's not like I'm adding to my 401k. I'm just kind of repaying it back to get back where I was. So I don't have that same kind of projection where I'm putting $1,000 a month to be able to go to, that's going to go towards retirement. Some of that, or half of it, or whatever the percentage is going to be used to pay back the loan.
Well, and then the other piece of it too is that money that comes out of your 401k that you've now used for whatever your loan reason was, is now out of the market. And so if the market does really well, that's money that's not earning money in the market. The market tanks. There's an argument that you've done the right thing. You took it out at the high, you put it back in at the low, if that's what happens. But it doesn't work out that way. And so you're taking money out that just doesn't have time to kind of get back to work and do what its primary purpose is, which is save for your retirement.
Save for your retirement.
Yep.
And so,
Yep.
if we're in a situation where someone is in a may need or want to or desire to take money out of their 401k, we'll make sure, and you do the same thing, is we'll make sure that we coach them up and say, okay, listen, let's understand this. Let's understand what you're doing. And how many times have you had a client where they're like, you're asking them about their assets, and they say, well, yeah, I have a 401k here, but I got a loan against it, right? And then, the first question will be like, oh, what was the loan for? And they're oh, because I wanted to pay off some credit card debt or something like that, or I wanted to buy a car, or something that really doesn't pass the common sense test of why I would go into my retirement and change my retirement account to be able to do it. So what are some examples that maybe you can think of where a 401k loan might be appropriate?
Real estate.
Okay, so why, again, for real estate, right? So
I love it for real estate only because, in theory, the real estate, you're putting it to an appreciating asset.
It's an investment for an investment,
That's
right?
right.
Yeah.
That's
so I'm taking money from said 401k investment, then I'm putting it to another investor. Now, there's a lot of risk that comes with that, right?
Yes.
Right? There's, any type of investment inherently has risk. So there's the risk of that this real estate investment that I'm investing in now may not appreciate. It may not work out the same way that I anticipated that it would, right? As with any investment. And I'm kind of taken from one, which I know what that investment is, and I know the risks that are involved with that. But at the same time, now I have a loan, right? And now I have a loan. So I do like that. I do like the idea of, now, do I use it all the time? No.
No.
I mean, if I have $100,000 sitting in a bank account that isn't earmarked for anything, and I have a 401k, and I want to invest in real estate.
Right.
What am I going to use? Most of the time I'm going to err on the side of taking my cash.
Well, this conversation dovetails
Love the dove.
Dovetails
Yeah.
right into
It's like release the doves.
what I was thinking about when you were talking about some of the things that you would, looking back, you would have done a little bit differently. And this was a common theme at that small mutual fund company that I worked at when I was in town.
Yep.
And the theme was that almost, let me say it first and then I'll backtrack and explain it, putting too much of an emphasis on saving for retirement and not enough emphasis or not some additional emphasis on companion investing that's not retirement investing. And so when I say that, what I mean is there are a lot of people who are working off of the assumption that I'm maxing out my 401k and that's the end of the story.
Yep.
Like I don't need to do anything else other than that. So you're living check to check because you're maxing out your 401k and you're not building up a taxable portfolio of assets to cover scenarios like the ones that we're talking about right now. So yes, it's great that you're putting all your money in your 401k, if possible. And I'm not saying at the expense of your 401k, but I'm saying along the way, let's try to build up a taxable portfolio of assets to cover things like, oh, I need some money, so that every time you need money, the option isn't put it on my credit card, take a loan for my 401k.
Yeah,
That's the idea.
where I'm financing
Yep,
it, right?
that's right. That's the idea.
And that goes like with just your basic blocking and tackling. What's my savings plan? What am I saving for?
That's right. That's
what am I
right.
saving for? So when you sit down, especially with like a younger couple or a younger family, and let's say they haven't bought their first house yet, right?
Yeah.
And you ask them, what do you want to do? And they're like, well, we would definitely love to buy a house. They're like, okay, so here's how much we have to save. So we're going to say, all right, here's. I understand. Don't get me wrong. I love saving for retirement, but at this stage of the game, maybe I don't save as much. Maybe I don't put as much into my 401k because I'm going to save it out because I'm going to use that money sooner rather than later.
Sure.
So I don't have to go into my 401k. So just to circle back on the 401k. So another issue with the 401k is, remember, you have to be employed with the employer.
Yeah.
So it has to be an active 401k. I can't take a loan off like an old 401k,
that's right.
that I don't work for. And the reason is because every time I get paid, guess what? That loan is getting paid.
If you lose your job,
There you go.
they want that puppy. They want that puppy paid in full. The bill is due.
Yeah.
So if that happens, or if you're going to change jobs, now you say to yourself, "I'm going to pay that loan back."
Yep.
So all of a sudden, you want to make a career choice that you know is a great long-term career choice for you and your family, but you don't have the 30 grand or the 25 grand that's outstanding on your 401k loan. So now you're second guessing whether or not you're even going to make that career decision. And if you do decide you're going to make the career decision and you don't have the savings put aside, where's the money going to come from to pay back the 401k loan?
It's going to come from your
From
401k.
your 401k, right? So it's you're going to default on the loan or whatever. So that's my point. Is I understand that at some point you get fixated on the house thing, and that's, to your point, that's almost easy because it becomes a self-fulfilling prophecy. Like, people really want the house, so they will laser-like focus on getting a down payment put together by hook or by crook.
Yeah.
They'll save for that 401k for the house purchase, but then they forget after that,
Yeah.
right? Like, they were able to scrape together the money to buy the place, and now all of a sudden, 2 or 3 years later, you say, hey, so you're back to putting money in your retirement account. That's great. What's your taxable portfolio look like? My what?
Yeah.
Your taxable portfolio. What money do you have laying around? Well, we have money in our checking account. We get $5 grand in our checking account.
we have no cash.
Right.
We have no money.
That's my point.
We have no money, and maybe you're not at the point where like you have enough money to build a portfolio and invest, but you don't have any cash.
Right.
Right. And again, we say this all the time. Life costs money. Like and there's going to be things. There's going to be opportunities that are going to come up, right? There's potential things that, oh look, this, these new bikes are for sale for my kids, and I really want to. They need a Christmas present, or they need a birthday present, right? Or my kids are getting ready to go to college, so I need.
But even like bigger level stuff, like the college piece is a whole nother animal, right? But like even bigger, I got to do my driveway over.
Yeah,
that's going to be 20 grand.
That's right.
I'm gonna probably have 20 grand kicking around my checking account. Great if you do, but if you have a portfolio that you can shave a couple of bucks in cash out of it and say, look, we don't have to put that on a credit card. We don't have to finance that. I'm not taking a 401k loan to do over my driveway. No. There's cash available to do that type of stuff. You want to have that around because, and we've said this on the show 1,000 times, something's going to come up where you're going to be like, oh my God, I'm so glad we have $100,000, and $100,000. I'm just picking a number, but I'm so glad we have cash.
Jay's just picking his own number.
I'm so glad we have cash
in the
to tap
pocket
into.
of my jacket.
Yeah, carried around. I'm so glad we have cash to do whatever that to do is.
Yeah, we have the flexibility to do that, and then if by chance we do decide to finance it in some way, shape, or form, we always know in the back of our mind that if the financing doesn't work out, or we get sick of it,
or just write the check,
we can pay it off. That's right. So the other thing about the 401k, so we mentioned a real estate investment could potentially be a good reason to do it, right? Or something that may make sense. The other thing is just a flat out emergency, right? Like your fault, my fault, nobody's fault. Let's just say that you need money emergently, right? And you don't have money in the bank. You don't have the flexibility to do it. And yeah, you could put it on a credit card, but your credit card is, and again, you've kind of mapped this out where you're not going to really be able to pay this money back. Let's say it's a substantial amount of money. So you're not going to be able to pay this money back in any short instance of time. So you're like, okay, well, I got to borrow it from somewhere. I have to get it. Where can I get it? And the 401k is not the ideal place to take it from.
because it's not an ATM.
No.
You want to borrow from your 401k, you're going to get paperwork. You're going to submit the paperwork.
Oh, it's not easy.
The HR department's going to review the paperwork. They're going to figure out where the money's going. It is not as simple as, let me just call Fidelity, TD Ameritrade, have them liquidate a mutual fund, and send me a check.
Yeah.
Wire me the money, which I can have it in a couple of days. It's a different process.
Yeah, so it's a big deal.
Yeah.
It's an event, right? So that's the thing. The important thing is, like, if you're taking money out of your 401k in the form of a loan, it's an event, and it's got to be for something that's substantial and real, and you have to understand all the ramifications. You have to understand like what it means, how it's going to affect your long-term retirement, all that stuff you need to understand and take that into consideration when you're making your decision. The last thing is that there's usually a limit too, right? So people are like, oh, well, don't worry about it. I'll be able to take a loan off my 401k to put the down payment on my house. I'm going to buy a $800,000 house.
Sure.
I'll be able to take
I'll borrow $80,000 out of my 401k.
$200,000 out of my 401k. You can't do it. Usually the limit is $50,000 for most plans.
It's $50,000 or half of what's in your 401k.
That's right.
So you get $75,000 in your 401k. They're not going to borrow 50. No, you're borrowing 37, whatever.
Yeah. So it's usually under most plans that we've seen, it's the higher of the two. It's either $50,000. It's the lower of the two, $50,000 or up to half of your 401k balance. So yeah, and again, this is just basic lending. They're not going to overlend on your 401k. So 401k, and oftentimes we'll see this mistake. We'll inherit these mistakes. We'll see a client will come in like, I got a loan on my 401k, or I'm thinking my plan was to take a loan off my 401k to buy my Cape house, and we'll be like, well, let's make sure we understand everything.
Yeah, make sure the long-term implications here are understood.
All right. So on the law side, what's a common mistake that you see? I mean, we go down the list, but it's a fundamental one.
Yeah, it sounds a little generic. But you know what we see? You know what causes the most problems for us is people trying to do it themselves.
Yeah.
And I don't say that.
How many times do you see it? Right?
And I don't say that because
you like your job.
Well, I don't say that because it's full employment for lawyers, right? That's not the reason for saying that. But what I'm saying is, there's a lot of things you can do yourself, and that's great, and I understand that. And then you have to own the responsibility of doing it yourself, right?
Yeah.
So if you want to be a do-it-yourself investor, your side of the aisle, right? If you blow that up, you can come into John and you can say to John, John, I really dropped the ball on my self-managing of this portfolio, and you're going to say, okay, well, here's how. I mean, fixing it means this. You know, the client's got to start saving more money. The client's got to change their spending habits. And that's really kind of where it kind of evolves to, right? What we see on our side is clients come in and say, hey, I did this on my own. I did one of these, you know, online POA things or these online will things, and then they come to us and I go, yep, this is terrible, and it doesn't do anything that you thought it was going to do.
Yeah, and you get to that point where people are coming to you emergently because they thought they had their stuff squared away. That they were like, I thought it was good, and then when we went to probate court, they were like, this.
And that's my point. My point is that while you, in the short term, you think you're saving yourself a couple of bucks, what you're potentially doing is creating real problems and real expense for yourself long term down the road. For example, and this has happened in the last, I call it the last 4 weeks.
Hey, wait, hold that thought. We're going to take a quick break.
All right,
So
take a
we're
break.
going to take a quick break. No, but you're, no, because
All right.
I want you to
All
get
right.
it. I want you
Hold
to.
on.
I mean, I want you to stretch.
This
I want you to be
this
ready.
This is the radio equivalent of running at a red light right now, while you're waiting for the light to change.
That's right.
All right.
That's right.
All right.
We're going to take a quick break. We're going to come back and talk about the common law mistake that we see, other than just flat out breaking the law. But that's a
Different
a
mistake.
different animal and a different song. All right. We'll talk about that in Ozzy Osbourne later on. Don't go away. We'll be right back.
And we're back. Money Law, My FM 101.3. Jay Marsden with the Marsden Law Group. John Drohan, Main Effort Financial. Tom steering us through the cosmos here at the.
I got that wrong.
What?
The Ozzy, I used the. It's
Yeah,
not
you-
breaking.
I
the,
don't
no,
know
it's
what you were talking about.
It's Judas Priest. Who's breaking the law? Breaking the law. Breaking the law. Bow, bow.
You got me.
What do you mean?
It's not my thing, but
You?
Whatever.
Whatever.
Thanks, Tom.
Seriously, thanks for thanks.
you were gonna
You're
go
a
off.
heavy. I mean, you're like a heavy metal guy, right? You got a couple concert T-shirts,
He
right?
Heisman'd you like it was nobody's business.
did.
Yeah, whatever, John. Sure.
Yeah.
Yeah, whatever you say.
Can I say shut up on the
edit
radio?
that out,
Yeah,
edit that out, edit
the
that
FCC
out.
lets you
Yep.
say shut it.
Yep, edit that out. So we're talking mistakes. We're talking things we would have done a little bit differently, not necessarily mistakes, but things that if
Things
we
you'd
could
like
have
to have
done-
seen a
Yeah,
client do
yeah,
differently, right?
Yeah. Well, what's funny about this, the way you just phrased that, what would you like to see the client done differently is, I was on the phone with a marketing vendor 2 weeks ago, and we were going through some stuff, and I said to him, can I ask you a question? He goes, yeah. And I asked this exact question. I said, when you guys go out for drinks after work, I said, what do you complain about guys like me who are your client?
Yeah.
Like, what am I not doing? What do you complain about that you wish and that you complain to me about your client, your other coworkers about that we're not doing? And he was very upfront about, these are all the things that we would love to see you guys do, that we wish you guys would do, that would make everything easier. And it was very helpful. So this is kind of that story. Like, what would we like to see clients have done? You know, what mistakes we'd like to see them avoid. And on the law side, we were just talking about the do-it-yourself approach. I'm not saying that it's impossible to do. I just don't love it.
But what happens? So what happens? So if I go online and I do like my online will, right?
I'll give you an example right now. Just before the break, we were talking about this. We get three of these situations in the last probably 3 or 4 weeks. Somebody rolls in the front door with arguably the worst do-it-yourself power of attorney document you could find
the
on
power
the
of attorney,
planet, right? And they come in and they say, look, the house is on fire, and we have this power of attorney document, and this is the keys to the kingdom, and this is what we need to get done.
Yeah.
And then the answer is not so fast, because as we explained to everybody, your power of attorney document comes with certain authorities. And if those authorities are not specifically called out in the document, you are assumed not to have them.
Right.
And usually what happens is the problem that people want to solve with that document, the solutions to solving that document are not baked into that power of attorney document. To the point that my conversation with somebody was, no, this wasn't a do-it-yourself. This was done by another lawyer. And I said, okay, well, that doesn't make it any better.
No.
Maybe makes it worse. And they said, well, I'm going to put
you paid for it.
They said, yeah, I'm going to put you and the lawyer together and you can figure this out. I said, look, you could put me and the lawyer together. I'm happy to have that conversation. I said, but it doesn't change what we're trying to do here. I said, it doesn't change the fact that this does not give you the authority that you think it does.
Yeah, and that's the thing, right?
So, and by the way, and then we can't fix it because the person who signed the power of attorney is now no longer able to sign a new power of attorney.
Yep.
So now we're in this. So the whole reason you did the planning, that you thought you were doing the planning, and the problem you were trying to solve is not solved.
So that's the thing, right? And people forget about that. People forget about, and that's a great point, the whole power of attorney and the durable power of attorney and the healthcare proxy. Because think about it, right? So if I do a will, if I write down on this piece of paper, like, I leave everything that I own to my family, and Jay gets to have, you know, Jay gets to have all the strings of my guitar except the G, right? Whatever. And this goes to and I die, and this goes to probate court, and the judge will be like, this is the most ridiculous will. But at the end of the day, something that's probably going to work out, right?
Well, it will work out, and there'll be some headaches along the way. But you're right. It will eventually.
It'll work out almost.
Eventually,
right?
it could be 6 years. Eventually, it could be 2 years. Eventually, it could be. But you're right. It'll eventually work itself out.
So that's the will piece. That's what when people think estate planning. That's the first. That's kind of the central figure.
That's what they focus on.
Right?
Yes.
Right. So that's not the crazy. That's not what Jay's talking about. That probably is going to work out. It's when you have to make changes when people are still alive, and that's where that durable power of attorney. Because, right, if I can't sign, if I'm incapacitated and I can't move money from my brokerage account to my checking account, I'm the only one that can do that.
Right.
Right. And if I'm the only one that can do that, guess what? Here's what financial institutions do. They're like, nope. The last thing we want to do. There's this thing called anti-money laundering. It is so hard to move money, to have anybody move money from one place to another unless it's documented and it's authorized and
you're the person who should be doing it.
That's right.
Yes.
That's right. So and what the durable power of attorney allows you to do is it allows you to do things, right, in the absence of someone who actually owns the account. You're doing that for them. It gives you the capacity to be able to do things such as move money or pay bills or sell a house or things like that.
Well, and then what happens, to your point, is when you can't you're trying to move money because why? Because something needs to get paid, right?
Yeah,
there's
like a mortgage or a tax bill.
That's right. That's right. Or an insurance. Something needs to get paid.
Or insurance premium, right?
So if you don't have the ability to do that, then you're just in this cycle where things are just getting progressively worse.
Yeah.
Progressively worse. Progressively worse. And then all of a sudden it comes to a head. And this could be on a financial piece of it, and then on the healthcare side, and we've seen this happen. You're in a hospital because you fell, you had a stroke, you fell off a ladder, some crazy scenario.
Right, that all happened at once.
Right, all at once, that's right. You're in the hospital, and the hospital says, well, now we need to discharge you to a rehab facility so we can ultimately get you home and get you better. Who's your healthcare proxy? I'm sorry, what?
Yeah.
You don't know because you're in some crazy medical situation, and the facility who's trying to discharge you wants to know who should they be talking to. And more importantly, the people who would intake you, they want to know two things. Number one, if we take John in the facility, who has the authority to admit him to said facility?
Exactly.
And then, of course, more importantly, who has the authority to pay said facility for taking in John?
Exactly.
And if you don't have those, no one's picking up the phone.
Nope.
There is no room at the inn. They do not want to take you in and then wait out your guardianship or your conservatorship petition, which could take 6 months, and hope that it works out.
Yeah.
And you on the other side, because the facility might say, well, you know what, we're a little bit interested in taking John in, but we need to get a sense of the finances.
Yeah.
And your answer is, well, I don't know what his finances are like because I'm not his power of attorney, so I can't even get a copy of a bank statement. And then they definitely say, yeah, no bueno, you're not coming in.
How many times have you heard the arguments? This is the best one. How many times have you heard the argument where someone's like, you know what, like when the subject of estate planning comes up, and we say, all right, so have you done any estate planning? And usually the most answers I get is like, oh yeah, we've done that. I'm like, oh, so you have a will, you have a living trust, you have a healthcare proxy, durable power of attorney. Those are kind of like the four, pillars
the bedrock documents of your plan,
right?
Yep.
So then they say, I'm pretty sure we did all that. I'm like, well, do you have a lawyer that you went to? Yeah, we well, maybe we did, maybe, I think we did that, whatever it is. And then the next answer you'll get is they'll be like, yeah, well, I'm going to be dead anyway, and I'm not,
sure.
it's not going to matter. And I'm going to be like, well, wait a minute. Let me ask you this. So if you get into a situation, let's say you get sick or you become incapacitated, but there's a chance, probably a good chance, that you're going to get better, right? Or that you're going to come out of it.
Yep.
When you come out of it on the other end, do you want your finances to be in total disarray?
Oh my God!
Because that's what happens. That's just like Jay's saying. You can't get to a place, or for whatever reason money can't move, or decisions can't be made on your behalf when you can't make them. Then guess what? Then it's going to be either people that care about you are going to pay out of pocket, right? So it could be your children that are, may have to, and that's going to cause all the problems.
And that's
that come
assuming they have the ability to pay out of pocket.
Exactly.
I mean, there's a study out there that says that a significant portion of Americans don't have the ability to write a $450 check for an emergency. So now you're going to turn to your family and say, hey, I need somebody to swing my mortgage, my property taxes, my insurance premiums for my health care, and my car payment, my car insurance, my electric bill, my gas bill. So if you guys could just swing that until I get better, and then get around
and then
getting down to the lawyer, and then
I'll square this away.
Sure, we'll take care of it now.
That goes on for a month, 2 months, 3 months, 6 months, and it adds up, and you're in that place where now you're or even worse. Let's say you have to go to some rehab center, or you have to go to some long-term situation, and you go to a place and the only place that takes you is the place that where you don't want to go, or it's 80 miles away from where your family lives, and so no one's going to come and see because they can't. And so these are like, it's like that whole, I'll worry about that, when I'm dead. I don't need to. No, you need to worry about it now, because it could very well affect you in your life now.
Well, and it's very okay for you not to worry about it. You just got to make sure somebody's going to worry about it. So if you're okay putting that burden on your kids, that's a different animal, right? But if that's your plan, fine, so be it. Not a big deal. Then that's a family thing. You guys got to work out. But that's the thing, and we've seen it a lot for some strange reason in the last, like I said, the last 4 to 6 weeks, where we've had a lot of dealings with different scenarios that have come up, and somebody has come in with a plan that just is not designed to address some of the basic things that we need it to address, and it creates, in many cases, a ton of problems.
Yeah, a ton of problems and a ton of work, and that's the other thing is, right? Because so then you finally get around to, like, oh, I got to hire an attorney. I need a lawyer, right? And if the lawyer's got to chase all this stuff down and chase people down, that costs money. Right?
Well, that's a great point, and for those of you who are going to roll over laughing when you hear this, and that's when we feel really bad. Right? When somebody comes in and says, "Look, Jay, we have this."
He does feel bad.
We have this problem that we got to fix.
Look at him.
And I'm sensitive. I'm sensitive.
You want to hold hands while you talk about this?
I'm sensitive to the idea that when somebody comes in and says, "Look, this situation that we're dealing with my family and my parents is a train wreck," and we say, "Well, train wrecks are unfortunately expensive, right?" And I'm not saying that to be facetious. I'm just saying, like,
in real
to
life,
your point, there's a lot of work that's going to go into fixing this, and then somebody looks at me and they say, well, can my parents' funds pay for something like this? And I go, if you have access to them and you're their power of attorney, yes. Well, that's why we're here, but we don't have any of that in place. Then the answer is no. And then you guys got to work that out. And this goes back to what we just talked about. So in addition to paying the ongoing bills to keep mom and dad, out of the poorhouse, now on top of it, you're going to pay a lawyer to help fix this problem that they should have fixed 4 years ago, 5 years ago, 10 years ago, on top of all of it. I mean, it just makes, people walk out of there and they're mad at us, and I understand exactly why. They're frustrated because I can't believe these people want this much money to fix this problem, and I can't believe my parents didn't do this, and and you're mad at them, and then they're mad at themselves, believe it or not, because they don't have the ability to write a $7,500 check or whatever the bill is or whatever the deal is going to be. So the whole thing is challenging. And all of it could be addressed by just a simple, again, if you don't opt for the full-on solution, you got to get a couple of things in place. And doing it on your own doesn't always, you think you're saving some money in the short term, and you could be costing yourself some real money in the long term because you have a real false sense of security.
And I don't know how many times we've seen it in our practice where someone comes in with some 10-year-old power of attorney, and they're like, yeah, I got one, and you're like, that's, and the financial institution that you're trying to deal with, they laugh at it. They're like, no, no way.
Well, you bring up a great point. That's the other thing. If people come in all the time and they'll, like, this happened the last couple of weeks, and they say, well, I was able to use this to do whatever, get the water turned off, like whatever. Somebody took it, right? I said, yeah, that was fine. The Eversource took it to turn off the account because they knew they'd just be bleeding money if they didn't take it. So there was enough there for them. But you know what? TD Ameritrade treats this treats letting you access mom's $750,000 brokerage account. They treat that a little differently.
It's a big deal.
That's right. They
It's a
treat that a
big
little
deal.
differently. There's more eyes on that, right? That's going to be a bigger deal, and it's not going to get it done. And
Right, because in their perspective, right, if they allow you access and it's not legal and it's not correct and you're doing it, not under the authorization that
Sure.
you're saying that you have, they're going to get held accountable.
yeah, someone's going to come back and say, "You're the deep pocket. You never should have allowed whoever
Yeah.
to have access to this account, which they've now spent down to zero, and that was our you just don't know where these things go." And so when you whip this power of attorney out and you put it on a table, everything comes to a screeching halt, and everybody goes, "Hold on. It's not your regular Joe Blow transaction. Everything gets more scrutiny, and you really need to figure it out." So those are the things that, we talk about, the things that we wish. Again, it doesn't have to, I'm not saying you have to go to the lawyer. It's in your best interest to get it done the right way. It's going to save you money in the long run.
Yeah, and the power of attorney and the healthcare proxy, like those really are those are great examples of things that will be time sensitive, right?
Yeah.
There's going to be something, and it's really going to it could be a game changer if something happens and you need to access money or
Look,
you need to be able to take
a
care
good
of
power of attorney, a good document, a solid, well-written document, and somebody with the advice and guidance to kind of execute on that, you can accomplish a lot with just the power of attorney.
Yep.
You can really almost back into an estate plan that can honor somebody's wishes. These power of attorneys that we see where they come in and they say, well, it doesn't go into effect until 2 doctors have signed off
Yeah.
on it and said that I'm incapacitated. And all of a sudden, you can only find 1 doctor to do that, right? So now,
Right.
1 doctor signs off, right now, so now you got a doctor signed off and you can't find a second one. And so then somebody will want to redo the power of attorney, and you can't redo it because you got a doctor's note that says that they can't sign a new power of attorney and you can't find. You're in this rock and a hard place that totally defeats the purpose.
Yeah.
And so you try to get cute with these things, and you think, oh, I'm gonna make sure that nobody can do this until this idea of getting somebody to to write
no
down
one's doing this,
to
right.
document your incapacity. It's tougher than you think.
Yeah.
And so, there's a gray area, and so these things become very challenging. Again, well written, well documented, with the right people in place, we can do miracles with this thing.
And so again, the point is, like, it may be in your best interest not to try and do something like that yourself. That's something where getting outside help or at least a set of outside eyes to look at it that understand it, to be able to say, yes, this is good, and no attorney's going to bless off on something just because you fax them something. They got to look at it, right?
Yeah.
And they'll, you as an attorney, if someone says, hey, listen, would you please check this out? You'd be like, yep, I'll check it out.
Well, shop
Absolutely.
around, get the advice and guidance, shop around, kick the tires, talk to different people, and talk about these types of scenarios and how they would approach them, how they would address them, so you get a comfort level.
All right, we're going to take a quick break. We're going to come back and talk about one more thing. Has a little
Oh,
more
boy.
some law
Woo!
and
Yeah,
tell you
baby.
one more common mistake that we see, and then we'll be done. And then
All right, love it.
And then the lessons will be learned. So don't go anywhere. My FM 101.3, Money in the Law, and Holliston Cable Access TV, Holliston Hub, HCAT. We'll
Love
be
it.
right back.
Giddy up. And we're back. My FM
Did Tom
101.3.
just speak?
Jay Marsden with the Marsden Law Group. John Droey, I'm NFL Financial. Tom chastising
Tom
us
just
from
speak.
behind the menu,
Three breaks.
from behind the camera.
I just.
He's concerned. He's concerned about the number of breaks.
I don't. Well, I mean, I thought it felt like it felt like a time to take a break.
I'm just
going
look,
with the.
Look, I'm just getting older. I'm just getting older. I don't. The gas in the tank goes a lot faster than it used to. I mean, I could use 3 breaks.
It's not like we're breaking.
At some point, I'm going to reintroduce the seats back in here again. Because we used to sit.
remember those days?
Now I'm like, then we get up because we're kind of moving and talking, but. I don't know. I don't know.
I mean, so before we get started, I'm going to tease next. So potentially, we could have the first live musical performance on Money in the Law.
Spend my whole
right
weekend
on Money
restringing guitars.
on Money
Good
in the
Lord.
Law.
All right.
Next week, again. We'll have a couple of seasoned musicians and a brand new one.
Yep.
But I'm looking forward to it. And
stuff.
fortunately, Jay and Ray have agreed to to hack along with me on our first actual radio and TV performance.
Penance, baby.
It's right. It's somebody. You got to start somewhere,
Yeah,
right?
you do. Yeah,
That's
you do.
right.
Yes, you
Keith
do.
Richards, when he started playing the guitar,
played the chord the first time.
people had to, they had to listen. Like,
You're not just born Bruce Springsteen.
No,
You gotta work at it.
No,
Yep.
no,
Gotta
you
work
are
at
not.
it.
All right.
Yep.
So we're talking about mistakes that people like. Some mistakes that we'd like to see. If we could do it over, have clients come in. But if we could do it over, say, I wish you did this differently. So
Sure.
in the same vein of kind of the law side, one of the things that we see that's very common is what people don't do is they don't review their beneficiaries in their
Bingo.
in kind of all things that when they're talking about like how they're going to leave their estate or like
Sure.
who's gonna inherit certain accounts or
gets
certain
what.
estates.
Yep.
Exactly. And what happens is people, like for instance, like on their retirement accounts, those are named beneficiaries. On their life insurance policies, those are named beneficiaries. In their estate plan, in their
Sure.
will, in their trust, those are named beneficiaries. And oftentimes, like when you do it, you do it, and you're like, who's going to be your beneficiary? And it's a quick thing. Oh, it's going to be my wife, and then if something happens to both of us, then it's going to be my kids. And we leave it at that, and then it never gets revisited. And time goes on, and life goes on, and you keep
we
paying.
see it all the time, right? Guys set up, 401k, IRA, life insurance, and then they're single at the time. Who's the beneficiary? My mother.
Yeah.
And then if you change it, and they get married, and they get 6 kids, and all of a sudden something happens to them, and guess who gets the money?
Yeah.
Mom. Yep.
Yeah, and all different things. Yeah, like their mother, right? Their mother who's 90 years old, right, and doesn't need the money necessarily.
And doesn't like the daughter-in-law, and doesn't like giving it to you.
So right, and so what happens is if the wrong person, if your money doesn't get left, if it's not to the person it's intended, it could create a whole litany of problems.
God, yeah.
So the idea of, for instance, life insurance. Jay brought up a great example. So the way life insurance works, remember, life insurance is a tax-free. So if I'm a beneficiary of a $1 million life insurance plan, I get a check for $1 million. There's no taxes. There's nothing staple to that. It's mine.
Yep.
Like that is my money, and I put it in the bank. Guess what? If the person who is insured, with their intent was that, oh, that wasn't supposed to go to you, that was supposed to go to you and your 3 brothers and sisters,
Right.
then you're like, that changes things.
Right.
That
But we left it to you because we thought you're the executor of the estate, and we knew that you would do the right thing when you got the money. And now, Ma and Dad aren't around, so you can't ask them the question, well, Ma, what was your intention with that life insurance policy that you and Dad took out? Because you can't. Nobody answers.
Exactly.
Nobody answers. So all you have is a piece of paper that says, well, the money goes to John.
Yeah.
All right, I don't know why Mom and Dad gave it to me. I mean, if there's some dysfunction in the family, you take that approach, and you'd be well within your rights to take that approach.
Right. And well within your rights to be like, this is my money.
And let me ask you this. How many times when you're in your office does somebody come rolling in with their paperwork and they pull out a life insurance contract, right? The original contract.
The one that's written on parchment paper.
That's exactly right. And what does it say in that contract? Who's the beneficiary? So you get to look back in time, and you joke around with them, right? You say, "Hey, do you know do you remember getting this policy?" And they may or may not remember.
Yeah.
Oh, yeah, the guy came to the house, he smoked a carton of cigarettes while he was sitting there. We had 4 Manhattans and filled out the paperwork.
Yeah,
and
the
he's
good
like,
old days.
And he's
Good
like,
old
yeah,
life insurance days.
That's right. But it was like it was
4 hours later.
But it was 1982, right? And so, well, I wasn't married at the time. I mean, I was dating that girl, and and
my
she's,
parents,
and she's on here as you see it in real time. What that everything wasn't automated like it is today. Like, I don't know.
Where you could see it online.
I clicked a bunch of boxes.
Correct.
You're seeing somebody handwriting in Ma and Dad or their sister or their, you see that and they think they're all set.
Yep.
They never go back and look at it ever again.
Yeah, and you see it in estate planning as well, right?
Yes.
People come in like, oh yeah, I have a will, I have a trust, it's all set.
Yep.
And with all the named beneficiaries, and back when they did it, it probably made all the sense in the world as to why these beneficiaries are named, or why this person is going to be the guardian of my kids. Like there's and if all of that, if you're not updating that, or if you don't make that current, or if you don't understand that that times have changed. And so
I can't tell you how many times I read back to somebody what their estate plan says, and they are aghast at what happened. I'm like, so now let me just make sure I understand here. So all the money is going to go to, I don't know,
Your brother.
a charity, a brother, your brother-in-law, right?
Yeah.
And then they're like, I'm not sure we want that. And then, by the way, the benefit of the trustee of the trust is this lawyer who's been dead for 20 years.
Yeah.
And then if it's not him, the trustee is this investment company that the lawyer's brother-in-law used to work for that at the time seemed like a great idea. They've long since gone out of business.
Yep.
I mean, you get these arrangements that are just a little bit off the beaten path, and people go, we need to get that updated. You can see it on the look on their face, like that is not anywhere close to what we want.
Yeah, so if you're there, if you're at that point, great, then you're in luck,
Yeah.
right? Then it's like, okay, now because the beneficiary piece all can be easily fixed,
Yep.
easily fixed.
Yep.
It's when something happens and you're after the fact, right?
Yep.
And you're at that point where, like we said, like you have, back in when you made your plan, you said, all right, well, I'm definitely going to leave $1 million to my one, son because the other children are financially stable. They're better, right? They're
Right.
okay. But now things have changed. Maybe that son has remarried or married somebody who now, like, so think about it, right? If they're in a relationship where things aren't going that well,
Maybe he's 4 times divorced.
they get $1 million.
Yeah.
Guess what? His soon-to-be ex-wife is going to say? She's going to be like, "Hey, guess what? I'm leaving." And
Winner,
oh, by the
winner.
way,
Winner.
Yeah.
He's 4 times divorced. Your other members of your family that you thought at the time seemed well off, you've now discovered that entire charade was smoke and mirrors, and they're nowhere near as
just
well
bad
off.
luck,
Oh, they've
right?
had some setbacks.
Yeah.
They've had some business challenges. They've had some financial issues, and you thought they were all hooked up, and they're not anymore.
Yeah.
And you can really make some changes here. So I'm with you on that. I'm
Yeah.
with you on that.
So again, the lessons learned. If you're going to take a loan off your 401k, make sure you understand what happens. If you are going to do it yourself,
You're going to go it alone on
you're
the
gonna
law side, think again.
Think twice. Yeah, think twice. Particularly not just for the will, but for the power of attorney and the healthcare proxy.
Yep. Get good advice.
Right?
Yep.
Yep. And then the last thing is, if you have for your named beneficiaries, for your retirement account, and that's the other thing, like with retirement accounts,
Oh,
right?
God, yeah.
Because people don't understand how they work. They don't understand that, like, oh, if I inherit a retirement account, then that has to be gone within 10 years.
Yeah.
It's a different type of investment. So make sure that you understand your beneficiaries, and then that kind of goes back with just understanding what your overall intent is. Which,
And to balance this puppy out, one more real quick, and then we'll jump. Blended families, seek legal counsel.
yeah.
Just get some advice, sit down, talk to somebody, whatever you decide to do, talk through the issues. We see that a lot. Blended families walk in and they go, it's the same as everything else, right? Could be,
Yeah.
but it could also be different. There could be some different challenges.
also be a
we could
lot
be
different.
balancing the scales a little bit differently. And so if you're in a blended family situation, you want to do some planning, it's worth the time to sit down and figure it out. Again, the end result could be the same, but it could be different. You want to understand your options going in.
Okay.
There you go.
All right, there you go. You have learned. Write it down. Have a great
learning.
weekend. All
Woo.
right, the weather's
Giddy
coming
up.
back. It's
Oh.
coming back.
No longer sweater weather.
No longer sweater. All right, everybody have a great weekend. We'll see everybody next week on Money in the Law. And remember, Money in the Law
Tune in.
music next
Money,
week.
Money Law, the music.
All right,
See you guys.
see you next week.